So, I wanted to bring you on, as you know, to talk about inflation. And specifically, I wanted to look at the problem of inflation from a left perspective. We've obviously been hearing a lot about inflation in the news, just in the political chatter. And the reason why I wanted to talk to you in particular is because I feel like the so much of the discourse around inflation, and especially in the mainstream media, sort of treats inflation as this mysterious, like natural process where your dollar is suddenly worth less, or prices just mysteriously like rise for no reason. It's sort of cast as this inevitable, like I said, magical phenomenon, right? So I guess just to start, a very basic question: what exactly is inflation, and why are we seeing it now?
Okay. Inflation is, of course, the phenomena of an acceleration of prices or price rises.
Hmm.
And economists understand it as an excess of spending relative to output. Okay, now this can be understood either as too much demand, which is sometimes called demand pull inflation, or constraints on supply, which leads to rising costs, cost push inflation. But and at different points of time in different situations, it could be either, right?
Hmm.
But from a left perspective, what is at stake is competing claims and distributional conflict. I mean, we need to see inflation from a class lens.
Hmm.
The institutional structural context matters, and that's how um, it works out, and inflation appears. Now, there's a piece forthcoming in Catalyst by Matthias Vernengo, which discusses this really clearly. So a little plug for that. But let me illustrate. Let's think of the 70s inflation. What's emphasized here is things like the oil shock, the Vietnam War, the war on poverty. But the inflationary pressures that built up in this period actually came up from the, can't understand them if we don't understand the unraveling of the capital labor accord post war, which basically wages were tied to productivity, workers committed to maintaining productivity, but in return, wages would rise as productivity rose,
Hmm.
right? There was a kind of accord, a detente, if you will. But by the 70s, you had rising worker militancy and resistance to this relentless ratcheting up of productivity. And there was a capitalist backlash against the squeeze of profits.
Hmm.
And this manifested in the inflation of that period. And this inflation was brought under control basically by policies which exacerbated unemployment, undermined unions,
Hmm.
and workers' bargaining power. The Volcker's interest rate hike, deregulation and liberalization policies under Reagan, they were basically instruments to this end. And so you then had the Great Moderation, which was an outcome of a successful rebalancing of class forces in favor of corporate capital. Outsourcing, offshoring kept real wages stagnant, and I mean, if before the 70s, wages and productivity kind of were in line; they moved together. Uh, in this period, basically, productivity outpaced wage growth.
Hmm.
So, in a sense, anti-inflation policy is about redistributing incomes uh, towards capital and squeezing wage share. And you see this in policy debates too. There's a trade-off posited between unemployment and inflation, but there's a class content to this choice. And for the working class, the priority is addressing unemployment. They're less inflation averse. For the capitalist class, inflation is the anathema, right? And there's a paper by Arjun Jayadev which actually uses survey data to bring out, substantiate these preferences of working class versus capitalists. And we need to apply the same lens to the current inflation, right? I mean, so if you want to understand what's happening today, you have to first see it in context. So, one context, of course, is the successful capitalist backlash, the liberal low interest regime, which was adopted after the 80s. And what you had was basically the rising dominance of finance and growing inequality, right? Inflation was held in check. You had what's called the Great Moderation, but asset prices soared. This led to the financial crisis in 2008, which is a reflection of this. I mean, the instability generated by this. But the tragedy and the paradox is basically that after the crisis, those trends have continued unabated. They've in
Hmm.
fact exacerbated. So when the pandemic struck, it struck at an accumulation regime, which had been set in place since the 80s, but this regime was already teetering. Okay, so and in terms of what I said about demand, basically excess demand and constrained supply, the pandemic affected both demand and supply, right? Production supply was disrupted because of the lockdowns and the safety concerns. Millions were left jobless and bereft of incomes, which meant they couldn't spend. The rich also cut back. The income was unaffected, but they cut back on luxury and essential high-end services, right? Restaurants, spas, etc., and accumulated savings. So you have the situation, and in which finally some relief measures were adopted. It shot up demand, but the disruptions of the pandemic remained. Specifically, you had disruptions to the global supply chains, and this clogged the system. And the prices rose most where the supply chains were affected. It was vehicles, and used vehicles too, energy, transport, food, right? And now there's talk of basically the unemployment problem has been kept in check, and there's talk of recovery. So the focus has shifted to inflation, but we're nowhere close to capacity of full employment. There's a 4% unemployment rate, but in terms of participation rate, how many people, how much of the population is actually entering the workforce, we are lower than what we were at the start of the pandemic. It's about 62%. It was 63%. We're even lower than where we were in 2008, which is 66%. So the economy is definitely not overheating. What you're seeing is supply rigidities.
Right. Yeah. So I wanted to follow that up by saying, because we're seeing this inflation, there's all this speculation now that the Fed is going to soon raise interest rates to fight inflation. So can you talk a little bit about what this would accomplish, or how would the government ideally fight inflation?
Okay. So first, if we see what the sources of inflation were, I said supply rigidities. And you also have, at the same time, basically the pandemic has exposed the precarity of work, right? And the relief measures have meant there's some safety net which was provided, and workers have begun pushing back against decades of squeeze, right? So there's some resurgence of working union activity and organizing activities, and there's what's been called the Great Resignation. Workers are basically saying, enough is enough. We're quitting these unless things change. We're not going to work under these conditions. But the balance has not shifted, right? And what a hike of inflation of the interest rate does is basically what it's trying to do is squeeze wages by basically triggering a recession. So the recession will squeeze wages, it will squeeze employment, and it will squeeze purchasing power. So you're trying to fight inflation by squeezing purchasing power of workers. Right, and creating unemployment, so that basically bargaining power also gets eroded. Now, this cure is in a sense worse than the disease, right? And it's also inappropriate in terms of fighting inflation, if that is a concern, because inflation is coming from supply constraints. It's coming from a squeeze of demand. It's not coming from a problem of demand. So squeezing demand is not the solution. What you need is to identify and invest in addressing these supply constraints, right?
So I want to go back to kind of definitions around inflation, because I think because a lot of progressives and leftists are sort of fed up with the traditional kind of centrist or conservative definition of inflation. You'll sometimes hear progressives talking about inflation as more like a kind of CEO or corporate collusion, right? Like they're all kind of like coming together to raise prices at the same time. And I think that this is especially pronounced right now because you actually do see a lot of corporations recently increasing their profits and their profit margins. So I'm wondering, do you think this is an effective or useful corrective, or does this leave something out too?
Okay, so first, what is this a corrective against? let me just start with that.
Yeah.
I mean, so for the conservative orthodoxy, inflation is the anathema, and social spending and expansion of the social safety net is unacceptable because it leads to inflation. And I mean, people like Michael Kalecki had argued even in the 40s that capitalists are going to always oppose or impede social spending because not because of inflation, but because it undermines capitalist control and power over the working class, right? And so this thing, I mean, this opposition to social spending is very deep rooted, and the same arguments were raised in the current inflation, and government spending is the villain of peace, and this was used to derail the Build Back Better plan, right? But the problem is not that the government spends too much on public infrastructure and social welfare, but the problem is it spends too little. The accumulation regime, which I talked about, growing inequality, financial instability, its limits have been tested. And what you see is a long period of erosion of productivity and productive capacity, a slowing down of the investment rate, what has been called secular stagnation. So the problem is actually, and the skewed and inadequate public spending in the last 20 decades has actually aggravated these problems. At the same time, the global supply chains that undergirded the Great Moderation, right? I mean, basically outsourcing, offshoring. This was set up on the premise of flexible, cost-minimizing responses to fluctuating demand, right? And the source of this flexible response was a flexible workforce and unrestricted trade and capital flows. The pandemic upended that, right? And the system, which was built to respond flexibly to demand shocks, could not respond to a shock to supply. And we need public coordination and more spending in order to resiliently adapt to supply shocks, right? So first, I want to just basically put that aside. Public spending as the problem it's not.
Right.
So now, in order to, and as you said, basically, I mean, stock prices and profit margins have definitely not been dampened by the pandemic. In fact, it kind of for non-financial corporations, it's grown. I mean, I think it was around 8% in Jan 2020. It's now around 14%. So they're doing really well, right? And this level was last seen in the 50s. So there is something to the idea that instead of focusing on growing government deficits or workers' demand for living wages as a source of inflationary pressure, let's turn the spotlight on profiteering corporations. Right? But the thing is that while the forging of global assembly lines and the supply chains allowed corporations to squeeze wages and costs and corner a larger share of income during the Great Moderation, even as prices were stable, the breakdown of supply chains with the pandemic is perversely providing them with an opportunity to hike prices. I mean, think of the four big meat conglomerates, right? Big pharma. So that is definitely happening. But if we think of inflation as a symptom of a deeper malady, right? And then the growth and concentration of corporate power is without doubt, I mean, a fundamental structural problem that needs to be addressed. And the kind of things which have been talked about, price regulations, antitrust actions, they would be part of the arsenal to check unbridled profiteering. Now, equally, strengthening institutions of wage bargaining and better working conditions are also essential. But one shouldn't lose sight of the fact that inflation is arising from supply constraints, which are pushing up costs. Now, these need to be addressed too. And to my mind, even more important from this, that where is inflation coming from? Is it coming from this cost push or from our demand pull? Is the fact that the pressing problem we have today is that tendency to secular stagnation I was talking about, declining productive capacity, declining productivity growth, flagging investment rates, right? And curbing corporate power is more important to addressing these underlying contradictions, which perpetuated secular stagnation. And I don't think the progressives should cede ground and allow the focus to be shifted from this and let the conservative inflation hawks usurp the agenda. Inflation is not the problem, the most pressing problem for the working class today. Secular stagnation, it's employment, and if we need to preserve that. And curbing corporate power is important. It's important for that reason. not as an inflation fighting tool.
So I want to go back to something that you said just a few minutes ago about how the problem is not too much social spending or public spending; it's too little.
Yeah.
That's interesting because you have obviously written about kind of, I guess, the rise of the Fed or the rise of the Fed in yes, there we go. There's your Catalyst article, COVID-19 and dollar hegemony. I'm wondering if you could talk a little bit about how the government has sort of retreated from fiscal policy, which has created kind of this opening for the Fed to take a larger role, especially since 2008, but obviously through the pandemic as well.
Yeah. And again, here we go back to the period 80s and the restructuring would happen at that point. So at that point, central bank independence, financial deregulation, and kind of liberalization was the push, right? It was a pushback against, the profit squeeze and the inflation in the 70s. In that regime, fiscal policy is kind of basically seen as, if inflation is the enemy, and any increase in social spending, especially if it's government spending, not so much, but social spending more so, right? The military spending, the deficit always increased during Republican regimes, and largely for military and related purposes, with tax cuts to corporations, etc., exacerbating the deficit. And that, the attacks on the social safety net, the attacks on public spending, basically meant the state is ceding ground of that and moving to basically a policy which uses monetary policy more than fiscal policy to pump the economy. So if there's, this is the origin of the famous Greenspan part, that is dot-com bust, lower interest rates. And so you had this low interest regime, which basically fueled the rise of finance. And so central bank independence means independence from, let's say, democratic control of through legislatures or whatever. But basically, it means that the central banks and finance are more closely aligned. Right? You see the revolving door between central banks, the treasury, and the big banks. And that is, in a sense, what we've seen. And even during great financial crisis, it was easier to do for the Fed to bail out than for the Congress to pass stimulus packages. And it was the recognition that the stimulus in 2008 was very inadequate, which finally forced some kind of stimulus or spending in response to the pandemic. But you see a big contrast between the way the Fed could push through its agenda and the way the stimulus Fed fiscal policy can be adopted. And it goes back to the point which I said about, quoting Kaleski, that for capitalists, anything which expands the social safety net or social infrastructure, it undermines capitalist control. Its ability to basically discipline the workforce, to the threat of retrenchment. It blunts the force of that threat. So it's kind of unacceptable. So with this regime shift, you had this push to not fiscal policy, and if it is, it's basically what's called asset Keynesianism, things which boost assets rather than build, social safety or social infrastructure. And so that the Fed comes at the forefront, the one institution which can act. Sorry.
No, so I think I want to just kind of wrap all of that up with a question about financialization, because we obviously we've gone through like a massive public health crisis in the pandemic. During this time, right as the economy craters, billionaires, we now know, made a combined $5 trillion, mostly thanks to the wild fluctuations of the stock market. So this might be a kind of like basic question, but why are the fortunes of the stock market so totally disconnected from the larger economy.
Yeah, it's crazy to contemplate.
I know.
I look at the suffering of the last 2 years, and it's the best year for the stock markets. It's the best year for the billionaires. Yeah. So part of the story, of course, is this accumulation regime of the neoliberal era, right? So the two elements which are key are the dominance of finance, and basically the import of the financial markets as a way of making profits. And the other is the growing polarization, the squeeze on labor, right? So while finance is not completely independent of the real economy, it has to be linked, and the link is periodically asserted in financial crisis. Financial accumulation does have some degree of autonomy, right? Finance thrives on self-fulfilling prophecies. I mean, if you think of asset prices going to rise and people start buying, it does rise, right? You also have the phenomena of corporate stock buybacks, where corporations are able to pump up their stocks by buying them back. And that also means that the executive pay, which is based on basically stock options, rises. And they get a bonus because stock prices are doing. So you have that regime. But while these are, since ultimately this period of autonomy gets a root shock, and you have the souring of expectations, the sentiment turns, you have a crash. Now, given the scale and reach of finance, basically every time there's a crash, you have to have bailouts, and we saw that even in the pandemic, right? So while the stimulus package, or even the Fed's program to boost employment, the Paycheck Protection Program, it had a bumpy start that was ridden with controversy. The Fed's policy to shore up the financial machinery, which had crashed, stock prices, treasury prices all came down in March 2020. Now, that policy was not marked by any of the hesitancy and the lack of purposeness that had characterized the state's response to the public health disaster and the other aspects of the disaster coming from the pandemic. So all stops were pulled out to bail out finance and arrest this crash. The tools that had been kind of deployed during the financial crisis were pulled out, but the Fed went even further. It kind of extended the safety net to corporate bonds, to asset managers. And so even when job numbers continue to be dismal, and the death toll was mounting, the stock market had its best streak. The finance gets even more powerful and more emboldened, because every time there's a crash, the scale and reach of finance necessitates the bailout, right? So the gains and upsides is cornered by a few. The state takes a burden of the risk, in effect socializing it, and finance continues to prosper despite the travails of the working people and the fact that the economy is flagging. And we're seeing that now. And this dominance of finance is also reflected in how the organization of production. So you have the same trends I was talking about: declining trends of investment, the ruthless restructuring and retrenchment, which is imposed on companies every time there's a merger or an acquisition. All this feeds on and fuels polarization, the concentration of income and wealth, and the declining share of workers. And so the fortunes of the stock market kind of have a life of their own, and have a kind of, in a sense, a stark kind of contrast to the real economy and the lives of working people.
I think something that sometimes is hard to kind of like wrap my brain around when we're talking about these sort of larger economic trends, or these structural constraints, or these structural problems is there anything that the left can do? I mean, putting aside the question of even like whether the left in the US it has enough power to do anything, like even putting that aside, how can we think about these larger economic problems on an organizing level, I suppose? Because while I take your point about the kind of factors that are undergirding inflation, I think the question is, like, can we do anything about it?
Okay, I think part of my message is that that the focus should be on things like uh, worker organizing,
Hmm.
worker unionization, things which allow workers to protect wages and improve their working conditions.
Yes.
Right. So, so that's one plank, and I think equally the plank of continually pushing back against corporate monopolies and what they're
Hmm.
doing is important. But the point I would like to make is that it's important not so much because we want to fight inflation. It's important because we want a better world, right?
Right.
A more equitable world, right? And while inflation reflects conflicting claims and distributive conflicts, right? So what you have to go to the heart of is those conflicts,
Hmm.
which are kind of appearing in the form of inflation. And as I said, the real danger is stagnation
Hmm.
and recessionary trends.
Yeah.
That will exacerbate unemployment. That will exacerbate. There's been some uptick in wages. That's going to be. There'll be a clampdown on that immediately. Whatever safety net kind of attempts to push the social safety net have happened will be again eroded. So we have to protect the social safety net. We have to protect the capacity of workers to organize.
Hmm.
We have to push back against, continually push back against corporate monopolies.
Hmm.
And the illusory whatever. This whole thing about finance is again really one has to understand how. How that. There's always a new bubble. So the whole
Hmm.
crypto thing, the non-fungible token thing, there's
Hmm.
always a new bubble which offers you quick. And now there's also this illusion of democratizing finance, right?
Right. Right.
Anyone can get it, and that is really dangerous.
Right.
So I think it's important to also talk about that.
Right.
Finance
Right.
affects everyone. So.
All right. So again, Ramaa Vasudevan is a member of the Catalyst editorial board and the author of Things Fall Apart: From the Crash of 2008 to the Great Slump. Ramaa, thank you so much for your time. And it was good to see you.
Yeah. Thank you so much.
Thank you. If you like this video from The Jacobin Show, please hit like and subscribe and share with your friends. Thanks.